The biggest thing holding back your business is probably not your taxes. It is the amount of time you spend thinking about your taxes. Now, that sounds backwards coming from a CPA CA, so stay with me because the order I'm about to give you is worth more than any tactic on this platform. So if you run a business in Canada, your feed is full of it. Holding companies, trusts, write-offs, pay less, defer more. Every one of those videos whispers the same message. The reason you are not further ahead is the taxes you are paying. So the pain is real, it's just that the message is wrong about the cause. And falling for it is not a character flaw. The content is built to press exactly that button. There is a correct order to building wealth through your business, and I have watched it hold for 20 years. Almost everything in your feed teaches it backwards. I'm Henry Wong, a CPA CA, 20 years in senior finance, PwC, Rogers, one of Canada's most iconic family-controlled companies. Over 1,000 advisory engagements and over 10,000 CPAs personally trained across Canada. And those engagements never lived in one narrow niche. They were different business models, different industries, different scales, from the owner running a single location to some of the largest family enterprises in the country. But here's the part that matters to you. I have sat on both sides of the table, outside as an advisor, as well as inside in the decision-making seats where decisions had consequences. And I've also gained my own lessons and my own battle scars as well as an entrepreneur. So I know the rule book. I also know what the rule book never taught. Living with the decisions is actually harder than the advice makes it sound. So hear from this video from that vantage point. Compliance matters, and it is the floor, and I will defend it all night. But an expert who steps at the floor only hands you generic advice. It's never tailored to your seat. I am here the way a partner shows up. I am a wealth structurist, implementing the 7 structures of wealth for family enterprises and business owners who are serious about building generational wealth. And I wrote the book on what I learned, the 7 structures of wealth. Because what I saw at that level, how real fortunes are built, protected, and passed on, almost nobody talks about publicly. One guardrail before we start. This channel is education, it's not advice. So every situation is different. Here is the order, and if you have my book, you know it is not an opinion. It is built into the framework. Cash flow control is structure 1, tax efficiency is structure 2. Just by the numbering, that is the guidance. Profit comes first, and only 2 investments genuinely move it. Investment 1, the business itself. That's your margins, your pricing, your pipeline, your expense control, and your team. For most owners, no fund on earth beats reinvesting in a machine you control. And here's a rough gauge for whether that machine is actually working. If you are reinvesting and producing revenue as well as margin growth in the range of 5 to 10% a year, you have a solid business. Now, industries differ, so treat it as a gauge, not a grade. But if you are compounding at that pace, protect it, feed it, and do not let a tax video talk you into starving it. Investment number 2, and this one compounds even harder. It's actually you. And when I say education, I mean education done right, in alignment with generating income for your business. And there's no certificates for that wall. Skill that shows up in revenue or expense reduction or learning how to build a team, as well as building leadership skills. Here's the part almost nobody frames correctly. That alignment is itself the first step to actually being tax efficient. So before you spend $1 growing your structure, because tax savings are actually capped at the taxes you pay. Profit, on the other hand, has no cap. And I want to share something with you that maybe nobody has ever told you. The tax system actually agrees with that. In my full demonstration, I put the entire Income Tax Act on one screen. You will see the practitioner's digital manual, as well as a special digital version that really puts into perspective the complexity of the income tax system. But before you go watch that, the executive summary is this. The lowest rate that the whole system offers is reserved for active business income that is being kept inside and working for your business. The road inside the business is the cheapest road in the code. So build it first, keep it compounding, and then pay taxes on real profit. That's the first receipt for having real profits. And the cost of getting this backwards, because I have watched the movie, thin margins, owners buying complexity they could not feed, then they pay professionals again to unwind it. Well, if your margins are thin, you do not have a tax problem, you have an economics problem. And no structure fixes economics. So here's your filter. Starting tomorrow, before any hours you spend on a feed or dollars go into the next tax idea, here's one question for you. Would what you do grow my profits faster in the business or in my own income generating skill? If yes, you found the real strategy. And if it was never on a tax video. Now, the other side of that map, because the code does not just reward the builder, it deters the parker on purpose. Building a business is not the same as building wealth. The income tax actually penalizes you. And this was a rule that was introduced in 2018. As a business owner, for being an investor, when your money sits passively, the interest, the dividends, and most income it earns while it is parked, the code can roughly take half of it. So the cheapest road in the code is the active road, and the most expensive parking lot in the code is inside your own company. So that's not an accident. It's also not unfair. It's a deterrent written in the deal. Now, you probably didn't sign it, but the code is telling you in its own language. Keep your capital moving. So you probably heard some really good advice with some good intention, but that actually can go wrong in your seat. Cash is king, or build an emergency fund. Both of them are true. Both of them are necessary for operating your business, but they are missing the half that matters now. It's all about the how and where you park your reserves. So the safety never triggers the penalty, because the default most business owners do is park it in a bank account, or because it doesn't have much activity or really fees, they park it in something like a GIC and lock it and get interest income. And those choices quietly produce the exact thing we just named. Idle capital, earning interest income, taxed at the penalty rates. Most financial experts were never trained to solve that. So bits and pieces of advice produce bits and pieces of an outcome. And worse yet, you could be walking into landmines. So you want the whole picture applied to your situation. Now, I say this from experience as well as from the inside, and this is with respect. At the beginning, if you are starting your business, marketing and sales and customer acquisition are the hardest part. Now, if you've got traction, you start climbing the mountain that most people never do. But most entrepreneurs, incorporated side hustlers, as well as early business owners, stay camped in that spot for a long time. The whole company becomes only customers, marketing, and sales, yet nobody ever introduces them to the departments that decide what happens to the money after it arrives. So meet the most valuable one you have never met. If you look at every public company, they run what's called a department, and it's called the Treasury Department. It's actually the company's own banking function, and it has one job: keep the money circulating so it compounds, and put it where the return is higher. You preserve it and you never let it slide idle, attracting the penalizing rates. Now, you don't have to have a public company's resources, because to run a treasury department with several professionals, you're looking at a budget run rate or an expense run rate of about $100,000 per month. So most owners, when they hear a treasury department, they immediately dismiss it. And that's not what I want you to do. The dismissal is your mistake. The value of that function can live inside your own company, except without the $100,000 team, $100,000 price tag, and the headcount. The function is actually a skill equipped with the right tools, as well as a skill, and this is what I work with for family enterprises and business owners, to install, implement, and educate them to use it. So this isn't really a headcount. It actually starts where every skill starts. It's by knowing there is a skill gap. So quick check. Do you know what your parked reserves earned last year and what rate that income was taxed at? If you had to guess on either, you just met the skill gap in person. And here's how you answer it for real. It goes through a self-audit, and that's actually for free. So ask first for your most recent T2, not the financial statements, the actual T2 corporate tax filing that went in with your signature on it, because most owners sign it without actually reviewing it. So there's two stops. The first one is the schedule that reports your investment income, where every dollar your parked money earns, it gets its own line and taxed at its own rate. So if you open your T2 and you scroll to it, and if a number lives there and nobody has ever walked you through it, what it costs, that conversation is now overdue. The second, the later pages of that jacket where balances carry forward year after year, while tracking the extra tax you paid on parked income, some of it is refundable if the steps happen in the right order. Those pages are actually the scoreboard of the parking penalty. It's sitting in a document you sign every year. So now tell me, most amateurs will point you at retained earnings on your financial statement instead. When a financial expert calls retained earnings your investable money, for me, that tells me they actually lack the sophistication to read what GAAP financial statements actually say. And to give you a bit of context, retained earnings is actually a bookkeeping construct, accounting profits minus dividends on an accrual basis. So it's not a bank account, it's not cash, and there's no tax character to it. It's not going to tell you what is investable, what is trapped, or what the next dollar going out of your company is going to cost you. But the T2 actually can. So when a plan starts from retained earnings, you just learned the depth of the plan. To be fair, the statements and the engagement you scoped with your CPA and tax compliance do is exactly the job they were scoped for. The job you need next is a different job, and that walkthrough is in video number 2. And then here's the second tell. And this one you can run yourself. Test their functional finance skills and experience. Ask them plainly, what do you know about the treasury function in a business? If they look at you like a deer in the headlights, well, that's all you need to know. If they get defensive, you just expose something real. And here's why this question matters more than any credential on a wall. You've been outsourcing your treasury function to a commercial bank this whole time, and you didn't even know it. The bank decides what your parked money there earns, and then they also set the terms it moves on. Because if you don't control how your money circulates, someone else is doing it for you. Someone else is dictating the rules on how you use your money. So let me ask you the way I would ask my client. Wouldn't it be important for you to be the one setting the rules? So this section handed you 2 questions. First, it's a name and a document, as well as 2 tells, how and where. Never just how much. Treasury is the named skill. The T2 is your scoreboard in your own filing cabinet. So the 2 tells that measure anyone who wants to advise you where their plan starts and what they know about treasury. A named skill with a measurable score can be learned, it can be borrowed, as well as being built. And now you can tell who has it. So when does a tax structure earn its place? It's not a feeling, it's actually a marker. And a really good marker is when you have consistent profits at scale year after year. With surplus, the business does not need to fund its own growth. And here's a meaningful number to hang it on. Alongside the passive income we just covered, active profits sitting just about $500,000 consistently is preferred. Why that number? Because at $500,000 and above, the corporate tax rates change. So when the rate changes, everything else and your decisions with your business actually changes with it. How you manage your treasury function, how your structure works, how your business activity flows. All of it now plays by a different set of rules. That's new waters, which raises the question I will keep asking you across this series. Do you have an experienced navigator to guide you through these new sets of waters? Before the marker, optimization is the distraction. After it, everything actually flips. The structure becomes the most important conversation you are not having. When it's too early, the structure is just a costume. When it's on time, it is the difference between your family keeping what you built and the default collecting on your silence. And let me be precise with the word structure so nobody sells you confusion. You already have a structure. If you are operating as a sole proprietor, that's actually a structure. If you are incorporated as an operating company solely, that is a structure. The stage the marker unlocks is the next layer, which is adding additional legal entities like holding company, investment company, integrating vehicles like trusts. That stage is real and it is powerful when it is on time, and it has its own episode on this channel. So this video's only job was to tell you when the conversation starts. So measure yourself against one sentence. Consistent profits scaled with surplus the business does not need. If you're not there, you just got all of your time back. If you are already there, then the surplus is parked somewhere right now and the skill gap is already costing you, and video 2 was made specifically for you. And here's one assignment. The same, whoever you are, pull your most recent T2 and run tonight's self-audit. If you are early, you will find almost nothing on those pages, and that is your proof. Your whole job is still profit, the business, and your own income-generating education. Now, close the tab and then go build. Structure 2 will still be here when you have something worth protecting. If you are past the marker, you will find the scoreboard already running, and that is your signal. Watch video 2, where I walk the filing with you and show you where your money is actually going. Either way, let the document decide. It's not a feeling, it's also not a video in your feed. And to see the full instrument played live, the complete demonstration is linked below. For the comments, let's have an honest version of it. In the last year, how many hours did you spend on tax content, and how many hours did you spend on getting better at your actual business? Those are two numbers. That ratio is going to be the most useful diagnostic in this video, and nobody has ever asked you for it. So one line to carry out. The villain tonight was never the tax system and never a professional. It was the distraction and the silence it buys. I'm Henry Wong, the Wealth Structurist. This channel is about education, not advice. Every situation is different, and remember, no one cares about your wealth more than you do. Education closes the gap, and the gap is the difference between you keeping your wealth and you losing it.